Hello everyone. Today I want to discuss something that has been center for global trade, investment, and financial security for centuries: gold. More specifically, I want to talk about why prices of gold keep fluctuating and what it means for us. Gold has always been a symbol of wealth and stability. Ancient civilizations used it as currency, kings and emperors stored it as treasure, and today central bank and investment use it as hedge against economic uncertainties. But despite its reputation for being a safe asset, its prices is far more from stable. If you look at historical trends, you will see gold prices and fall unpredictably. Before starting why this happens, I would like to discuss a story. So my father's great grandmother stored 10,000 rupees as insurance if it requires in future emergencies, and we have recently found that hard cash. But instead, if she have stored the gold of same amount, we have calculated that it would worth crores. So the things would have been different, which is from now. So why does this happen? So the first reason for it is supply and demand dynamics. Like any other commodities, gold prices are driven by supply and demand. When demand increases, whether due to more people investing in gold, rising in jewelry sales, or technical use in electronics, its prices tend to rise. On the other hand, if mining companies produce more gold than market needs, supply outweighs demand, leading to drop in prices. Mining challenges, geopolitical restrictions, or environmental concerns can also limit supply, pushing prices up. So the second reason would be inflation and currency fluctuations. Gold is often considered as hedge against inflation. When inflation rises, the value of paper money decreases, and investors turn gold as a way to preserve their wealth. This increases demands and drives higher prices. Similarly, when major countries like US dollar weakens, gold prices rise because it becomes cheaper for investors in other countries to buy it. However, when inflation is low and economics are stable, investors may move their money to stocks, bonds, or real estates, causing gold prices to decline. And that's the safest thing to do also, according to me. So the third thing that I would like to discuss is gold uncertainty and crisis events. When there is financial crisis like a war or political instability, gold prices tend to surge. This is because gold is seen as safe haven asset. Sometimes people can rely when markets are volatile. For example, during 2008 financial crisis, gold prices decreases as investors panicked. Similarly, global events like COVID-19, trade wars, or natural disasters can impact gold prices. In contrast, there is economic confidence and political stability. People feel safer investing in other assets. So gold prices often declines. So gold is the most safest bet you can take while doing the stock evaluation also. You can divide that in 50, 30, 40, 50, 30, 20. So 20% you can invest in gold for future security, because even if the company falls or the currency falls, the gold price is going to rise because it's inversely proportional to the inflation. So the next thing that impact the gold price, we will talk about interest rates and central bank policies. One of the biggest influence of gold price is interest rate by central banks like the US Federal Reserve. When the interest rates are high, gold becomes less attractive because of other investments, such as bonds, saving accounts, other bank returns. By when interest rate drops, gold becomes more appealing since it doesn't pay interest or dividends, making it a relatively better option for investment. That is why gold price often move in opposite directions of interest rates, because there are mostly 7 to 8% hike in gold price every year, which is a trend being seen in the last previous 5 years. And bond usually give interest rates between 8 to 10% and accept its yield to maturity. So sometimes it is always like bonds and uh, interests are considered better option than gold. But gold is even more safer because bonds are not that bonds are methodically high risk reward. So we'll talk about speculations and market trend. Just like stocks and cryptocurrencies, gold prices are also influenced by market speculations. Investors and traders constantly try to predict where prices will go next. When big institutional investors start buying large amount of gold, prices rise due to increased demand. Similarly, when they sell off their gold, holding prices fall. Media reports, expert predictions, and investor sentiments all contribute to the price movement. That's a very major factor to influence the gold price in the market trend. So I would like to conclude all my points at last, which is the next time you see the gold prices fluctuating, remember, it's not just a random change. It's a reflection of global economic trends, political events, investor behavior, and central bank policies, as we have discussed it earlier. So gold remains one of the most sought after assets in the history, and understand its price movements can help us to make a better financial decision. Whether you are an investor, a trader, or simply someone who likes to keep an eye on economic trends, gold prices fluctuations are something that worth paying attention to. So that's how I would like to conclude my whole information. Thank you.